So we'll briefly now run through amortization of intangible assets, okay? And really, we're going to account for amortization of intangible assets in almost an identical way for the way that we accounted for the depreciation of the tangible assets. The big difference here is that there's no accumulated amortization contra asset account, okay? Once you amortize it, it's just, you really are just directly reducing the value of that asset. Unlike with a tangible asset, where we are kind of indirectly reducing the value of it. So allocating the cost of intangible assets to an expense over time is what we call amortization. Again, this is almost exactly like depreciation. We're going to do straight line amortization. We're not going to do anything funky. It's just going to be straight line amortization. We'll handle it almost the exact same way that we handled depreciation for tangible assets. Now, most intangible assets have a finite useful life that can be estimated or measured. Usually, it's regulated by legal or contractual provisions. Okay, somebody is going to tell you it has to have this, and it is not an accountant. It is not an actuary that works for you. It is not somebody doing analysis. It is the government. It is a contract that you've signed. Somebody is telling you what the useful life is. Okay, so here is an example of the amortization of an intangible asset. So let's just say that Little King Sandwiches acquires the franchise rights for $800,000 for a period of 20 years. So we would just take that $800,000 divided by 20, and that's $40,000 amortized each year. And then it also acquires a patent for $72,000 with 8 years remaining on the legal life of the patent. So that 72 divided by 8 is going to be 9,000 amortized each year. Now, this 8 years is something that was told to us, okay? Somebody told us that's how long was left on the patent, okay? We didn't get to make that up. When we purchased the patent, somebody told us, hey, there's 8 years left on this patent before you have to refile, okay? So your journal entry is going to look like this. You're going to have an increase to amortization expense, an increase to amortization expense. You are going to credit your franchise each year. This is a decrease to an asset. And you're going to credit your patent each year. This is a decrease to another asset. So both of these are assets, right? That's what we're talking about here. We're talking about LTAs. And these are both intangible assets. You can't actually hold the franchise in your hand. You can't actually hold, I mean, you could technically hold the patent in your hand, I guess, but that's usually recorded somewhere. The next thing we got to talk about is the disposal of long-term assets. This doesn't mean you're just rolling it down the hill. You're not setting a truck on fire and just rolling it down a hill. This means you're probably selling that asset, right? So really, when we talk about disposal, we've got two different, at least in this class, we've got two different kinds of disposal that we'll talk about. If you move on in accounting, you will talk about other types of disposal. But really, for the purposes of this class, we've got to talk about these two here. The first one is sale. So you're going to sell it. This is the most common way that we dispose of long-term assets. Okay, it involves a transaction where cash or a receivable is received for the asset given up. Typically, in this class, it's going to be cash. Okay, and then you have retirement. This is when the long-term asset is no longer useful, but we can't sell it, right? So, for instance, my wife and I were just talking about getting new Apple Watches because I have an old one. It's like a Series 3 or something. I've had it for years and years and years. And I said, well, can we trade them in? Is there any trade value? She said, nope. They won't even give us $1 for these things. They're so old. That is retirement. I can't trade it in. It's not worth anything. But it's not really that useful to anymore. You know, I've got the most updated iPhone, so a lot of it doesn't work with the watch. You know, I'm just going to have to, quote unquote, retire this watch. It's basically going to be something that my 6-year-old kid gets to play with now, right? So that's retirement. So when you sell an asset, you're going to recognize a gain or a loss. Again, these are just review terms that we've talked about, right? We may throw an additional term in there, maybe get a little deeper into it, but this is all stuff we've talked about earlier in the class, okay? So the difference between the cash that you receive, this is called a proceed. So when we say proceeds, just know it means the money we got for the sale. So the difference between the proceeds and the book value, remember the book value is your depreciable base minus any accumulated depreciation, right? So your proceeds less your book value is going to be recorded as a gain or a loss. A gain is obviously when you sell it for more than the book value. A loss is when you sell it for less than the book value, okay? Please note, this is important. This is important. This will be important for problems that you work. You have to record depreciation up to the date of disposal. Otherwise, you will overstate your book value. And that will cause your gain or your loss to be an error as well, okay? Now, typically, we're not going to make you go up to the date. We'll say you'll sell something at the beginning of the month. Typically, that way, when you do your depreciation calculations, you are up to date on them. Okay. So here's an example of the long-term disposal asset. So let's say, the truck that they purchased in year one for $40,000, right? They're going to sell at the end, and this is important, at the end of year three for $22,000, okay? So they're going to take their original cost of the truck, they're going to reduce that by the estimated, by the residual value, the salvage value, what they think they can get for it. This gives us a depreciable base of $35,000, if you remember, okay? And then their estimated service life, they divide this by their estimated service life, and that gives them their depreciation each year. So their sale amount, what they sold it for, remember this is the proceeds, okay, was $22,000, less the original cost of the truck, less the accumulated depreciation, right? So this together makes your book value. So your sale amount, your proceeds less your book value is your gain, okay? And in this instance, we have a gain of $3,000. So it was the way we got that accumulated depreciation was 3 years times $7,000. Remember, let's look at our accumulated depreciation account here. Remember, it's a contra asset account. So year one, 7,000. Year 7,000 in year two. They told us it was the end of year three, so we had a full year's worth of depreciation in year three. Add those together, we had $21,000 in accumulated depreciation. Okay. So that is how we would find the gain. Now, how do we journalize that? How do we record that? Well, we're going to increase our cash, our asset, because we got cash for it. We're going to decrease our accumulated depreciation. We have to get that off our books now, right? We cannot leave that accumulated depreciation on our books any longer. Okay. And then we are going to decrease our equipment because it's no longer on our books either. So if we add these up, we see it's $43,000. Okay, we know that our debits and our credits have to equal. So we know we need $3,000 in credits. That is a gain. Why? Because this is other revenue, right? So we're going to increase a gain here. Okay. So, just a note, I get a second to kind of look over that, but just a note, okay? The book value of the asset is equal to its historical cost less its accumulated depreciation. When we sell that asset, we have to take the equipment at its historical cost because remember, that equipment stays on our books at that $40,000 forever. So we take that off our books, but we also have to take the accumulated depreciation off our books. Otherwise, we have an account just sitting there that doesn't make any sense. It doesn't go with anything, right? So just remember to remove both of those from your balance sheet. Okay. So long-term asset disposal example here, we're going to have a loss. So a loss is going to have the exact opposite effect of a gain. So let's say that they sell. This should be 17,000. Okay. So let's say they sell the same truck at the end of year three for $17,000. Remember, this is the end of year three. Okay. So same calculation up to here, except now our sales amount is 17. We find our book value to be the same, 19,000. So we take 17,000 less 19,000, right? This is just the formula that we talked about. This is just your proceeds less your book value. equals your gain or your loss, right? This is something you want to know for your exams. What does it give us? Well, it tells us we have negative $2,000. If it's negative, it is a loss. Remember, this is like an other expense. Okay? The way that is going to look will be very similar to the way it looked in the last journal entry, except here, we're going to increase cash because, again, we did get cash, but we're going to increase this loss. Okay, this is an increase to a loss, which, if you remember, is just an other expense. Okay? We're going to decrease accumulated depreciation again, and we're going to decrease our equipment again because we have to remove both of these from the book. Okay. So let's talk really quickly about asset analysis. This is the last thing we got to talk about in this chapter, and then we will move on to chapter 8. So what we're going to talk about right now is return on assets. Okay. And this is going to indicate the amount of net income that you generate for each dollar invested in assets, okay? So the way you find this is your net income. Notice it's net and it's income. Just remember, this is your bottom line, guys, okay? This is the last line on your income statement. Here, we have average total assets. Notice again that we are using a balance sheet account in the denominator and an income statement account in the numerator. When we do this, we need to use the average of the balance sheet account. Okay? So we are using average total assets, not just total assets. Okay? So we can look at two companies here that both wildly successful, but wildly different in many ways. Okay? So it's Netflix and Disney. I would imagine almost everybody, nearly everybody in the class knows who these companies are. Okay? This is all the information they're going to give us right here. We got net sales, net income, total assets beginning, total assets ending. Add these two together and divide by 2, right? And that gives you your average. Okay. So our net income divided by our average total assets is a return on assets of 13% and a return on assets of 5.4% respectively. Okay. So the components of return on assets can be broken down into the following formula. So you can take return on assets equals profit margin times asset turnover. Okay? Your profit margin indicates the earnings per dollar of sales, your net income divided by net sales. And your asset turnover measures the sales per dollar of assets invested, net sales divided by average total assets. If we do this mathematically, okay, we will see that we eliminate the numerator and the denominator here, and it just gives us these, which is equal to this, net income divided by average total assets, right? So you've got your profit margin here, and you've got your asset turnover here. Okay. If you eliminate those, you get your return on assets. Okay. All right. Any questions about Chapter 7 stuff, please feel free to email me or set up a time to meet with me, set up a time to meet with the tutors. However you want to go about doing this, I am more than happy to help you guys out.